Alright, so we're going to look at the allowance method for So with the allowance method, it's typically required for companies with large amounts of accounts receivable. So most of your big publicly traded companies are required to use the allowance method. What the allowance method essentially is you estimate how much of your accounts receivable is not going to be collected, and you record your bad debt expense based on that estimate. So if you have $1 million in sales and you project, $120,000 of receivables not to be collected, that estimate of $120,000, that will be your bad debt expense. Versus the direct write-off method we looked at before, where you recognize bad debt expense as you wrote off uncollectible invoices. So here's an example. So this company estimated their uncollectible accounts receivable to be $30,000. So out of their total of $200,000 of accounts receivable, $30,000 they estimate to be uncollectible. So their net realizable value is $170,000. So looking at the accounting, we have a contra asset called allowance for doubtful accounts. Which, remember, contra assets are assets which carry a negative balance. So our allowance for doubtful accounts has a balance of negative $30,000. We have bad debt expense on the income statement for $30,000, and expenses reduce retained earnings by $30,000. So when a customer is identified as uncollectible, it's written off against that allowance for uncollectible accounts. So let's use Joe's Lawn Service, for instance. So he does some work in August for a customer. He sends him an invoice and finds out in October the guy fled to Ecuador. He knows he's not going to get paid. So what he would do, reduce accounts receivable by $6,000 because he's not going to get that $6,000. It's not an obligation for anybody to pay anymore. So accounts receivable has to be reduced. Then we're going to reduce allowance for doubtful accounts by $6,000. Remember, allowance for doubtful accounts has a negative balance, so to reduce it, you would add a positive number to it. So let's say the guy comes back from Ecuador 6 months later and says he wants to pay his $5,000 invoice. So what would our accounting be for that? Well, we're going to first reverse the entry we did to initially write the invoice off. So we're going to add $5,000 back to accounts receivable and add $5,000 back to allowance for doubtful accounts. Which, remember, increasing allowance for doubtful accounts is adding a negative number to it. Then the second part of the transaction would be recognizing the invoice being paid. So increase cash and decrease accounts receivable. So to estimate the uncollectibles, so remember a few slides ago we looked at $30,000. You would use a past experience, industry average, and forecast. The key here is that it's an estimate, but that estimate has to have some substance behind it. So the two common ways that we see are the percent of sales and analysis of receivables methods. Percent of sales would be you have $1 million in sales, you think 12% is uncollectible, it'd be $120,000. Analysis of receivables is where we look at maybe an aging trial balance, look at some aging receivables, and do more analysis. We're going to look at both methods. So looking at percent of sales, so here we see that December 31st, they have a negative balance of $3,250 in the allowance for doubtful accounts. They estimate that 0.75% of 2012 credit sales would be uncollectible, and credit sales was $3 million. So we take that 0.75% of $3 million, we get our allowance for doubtful accounts number, we plug it in, $22,500, and then that's also our bad debt expense on the income statement for $22,500, and we know expenses reduce retained earnings on the balance sheet. Now, if we want to analyze our accounts receivable, this is what's called an aging receivable schedule. So if we look at column A, that's our customer number. Column B is the total balance that those customers owe us. Column C is the balances that were owed, but they're not past due yet. And then column D are items that are 1 to 30 days past due, E 31 to 60 days past due, and so on. So what this tells us is, for instance, BT Bar on column 5, they owe us $6,100. $3,500 of it is 91 to 180 days past due. $2,600 is 181 to 365 days past due. And then in row 23, we add up the totals. So we're owed a total of $240,000. $125,000 of it is not past due yet. $64,000 of the $240,000 that we're owed is 1 to 30 days past due, and so on. In row 24, we estimate the percent of uncollectible based on its past due status. So for the amount not past due of $125,000, we think we're not going to be able to collect 2% of that. The amount that's 1 to 30 days past due, we don't think we're going to be able to collect 5% of that, and so on. So if we multiply the $125,000 in row 23 by the 2% in row 24, we get the $2,500 in row 25, which that's our estimated uncollectible accounts. So this would be the analysis of receivables method. And the percentages on row 24, those are estimates that the company makes. So for instance, the column H, that is 181 to 365 days past due, maybe that 50% in row 24 is from historical trends in the company in the past, that they know that 50% of it probably won't be able to be collected. What this in row 25, so it would be cell B25, the 26,490, that would be our estimated uncollectible accounts. So we figured out in the analysis of receivables method that we have 26,490 as our estimate of the uncollectible account. We already have a balance of 3,250 in the account. So to get from 3,250 to 26,490, we have to add 23,240. So if we take the 3,250 that's already there, plus the 23,240 we're adding to it, that gets us to the 26,490 that we want it to be. So as usual, we increase our allowance for doubtful accounts. Remember, that's a negative number. We do bad debt expense on our income statement, and expenses reduce retained earnings on the balance sheet.